I think oil markets have gotten pretty used to the fact that oil tends to be produced in pretty high volatile, high political risk parts of the world. So if the geopolitical premium is not already in the price, I don't think we're going to see much reaction here on in. It's important to remember that these political events are happening at a time when there is enormous amount of spare capacity in crude oil production around the world. So even if we had a very brief interruption to a pipeline because of these attacks, or for instance, Azerbaijan's production, which does not seem to be at risk at all at the moment, could be affected. There are a lot of other countries that are holding back output at the moment that could easily increase output to compensate for it. It's also worth bearing in mind that as this political crisis might be developing, we're seeing one start to unwind or start to come to a resolution in Libya, where production there has tripled in the past week. So there are some compensating factors at bay here in the oil market.
Absolutely, Ed. Hi, it's Dan here in Dubai, and that leads perfectly into my next question on Libyan output. Is this a material risk for the market, and how are you assessing that output starting to come online now?
Yeah, I think it has changed some of the perspectives, certainly around the Brent market, where prices have started to come off a little bit, and it looks like in September we're going to be down month on month for the first time in quite a while. Also, investors have been pulling out of their long positions in the Brent market much more than they had been doing in the WTI market. And I think that does relate directly to the effect of Libyan crude coming back into the Atlantic market. So Libyan production has obviously been very volatile as the country has gone through a tumultuous civil war. It does look, though, like the national oil company is more confident that it's able to open its oil export terminals and allow crude exports to get back out onto the international markets. Now, we're still a long way from where Libyan production was at the start of the year. Reportedly, from the national oil company there, they're talking that production is around 250,000 barrels a day. At the start of 2020, Libya was producing over 1 million. So there's quite a lot of room to go. Libya is also not part of the OPEC Plus agreement, where it would have to withhold production or restrain production. So if it did increase production, it would be coming at just a time when there is increasing anxiety over the level of demand going into the fourth quarter and turnover into 2021.
That's exactly right. So adding more oil to a fragile market, and especially at a time when the demand picture is very weak. Ed, do you think that that new Libyan output changes the calculus or shifts the narrative for the OPEC Plus group, who might have to change strategy here in order to compensate for that extra oil?
Yeah, I think it does create some anxiety, and I think it reinforces the message that we've seen, at least from Saudi Arabia, that compliance is key. Compliance has been pretty good since the start of this agreement, since this agreement took place back in May, but ensuring that each country hits their target, and if they have exceeded the level of production they're allowed to do, that they make those compensatory cuts is going to be quite crucial. So we'll be seeing probably some more sort of verbal pressure from the Saudis to keep that compliance level intact. And then the big question would be, is at the turnover of the year from January, OPEC Plus is meant to increase production collectively by 2 million barrels a day. The market may not be prepared for that. So we may see the current level of the cuts being extended for a little while longer to give the oil market that much more time to recover and absorb it.
Indeed, so all eyes on the OPEC strategy. Ed, just before we let you go, any thoughts on where prices are heading from here, and are we likely to see oil sub 40 all the way out till the end of the year?
Well, our expectation for Q4 prices would that they would come in at an average at around where they are at the moment. So the sort of low $40 range for both Brent and TI. I think the risks are to the downside at the moment, particularly if we see an escalation in the number of coronavirus cases. We have more anxiety about them rising in Europe, but if we saw an escalation or more lockdown activity in places like India, where demand was meant to be one of the big star growers this year, but has really underperformed, that could send more shivers down the spine of oil markets. Big questions also about the outlook for the United States. If we see a resumption of any kind of lockdown activities there, the curtailed transport activity, that could really kill the fourth quarter performance of oil prices and send prices lower.